is, again, Panache talked about this a little bit, where there is a change or a general shift in the landscape. Doesn't mean that people aren't raising funds right now. Of course they are. But because this particular session is focused on scaling from zero, I wanted us to have a conversation around the basics when it comes to fundraising. And when I say basics, right, I'm talking about those embarrassing questions that you're probably too shy to ask in public. Because at the end of the day, no matter how experienced the founder is, from my own experience, just speaking to different founders, we have a situation whereby because people are too embarrassed to ask certain questions, they make very costly mistakes. So I want you to understand that this is a no judgment zone. We are going to have, sorry, just noticed I had lipstick on my, we're going to have very basic granular conversations. I'm going to break things down. I'm not going to have, I'll try as much as possible. I can't make any promises, any full promises to that, but I'll try as much as possible not to use technical terms, and where there are technical terms, I'll explain them. At the end of the day, you need to approach fundraising generally from a position of strength, because that's where you are. Investors are not, except you're trying to get, even when you're trying to get a grant, right? Investors have a job to make returns. Returns is exactly why they're there, right? So essentially, for an investor to approach you in the first place is because they believe that your business is what's approaching. For an investor to listen to you in the first place, right? You're having a conversation, and for them to listen to you is because they believe that there is something there for them. So you need to understand that it's a two-way street. And once you approach it like that, then it becomes a little bit better for you to navigate. The second thing to also note is that, and why I started from approaching it generally from a position of strength, is because in order for you to even approach something from a position of strength, you need to understand exactly what's going on. And that's what we're going to talk about in this particular session. I'm going to, my slides are still not up. But let me see what's going on.
Hi Mo, your slides are up.
Okay, so my slides are up now. Okay, cool. So what do we do? How do we do this? When I'm speaking and I want to move to the next slide, I just tell you to move to the next slide?
Yes.
Okay, fantastic. So before I move into this, in the comments, right? Can people just tell me, has anybody in the comments gone through a fundraising process before? Has anybody in the room right now gone through a fundraising process before? Is that a no? Is that a yes? Okay. Well, my next question is also, it doesn't really matter if you've gone through a fundraising before. If a startup or a founder is trying to raise funds, what do you think is the most important thing that they need to know? What do you think is the most important thing about that process of fundraising? Is it, yeah, what do you think that is? I would wait for, let me type it. Okay, so I have one here that says the legal agreements. Do we have who they want as investors? Okay, that's a good one as well. One more, two more. We're not sure. You don't know who to reach out to. Okay, that's a good one because again, yes, who to reach out to. We'll talk about that as well. Okay, so we have three responses here. We have the legal agreements, who they want as investors, who to reach out to. That's very important. And those things are also some of the things to consider as well. But I would say that one of the things that is the most important one, I didn't quite get the main thing I was getting at is your ability to not take anything too personally. I know that that's very niche. That's very, specific. The reason for that is because you're going to be talking to a lot of people. You're going to be hearing a lot of no's. You're also going to be hearing a lot of people who would, have reservations about how your business is being run. And depending on how they approach giving that feedback, it might, it's easy to take it personally because this is something you are building with your sweat, something you've put in a lot of effort in. And you're like, hey, I'm the one in the arena. So it's very easy to take things personally. But you need to go through that process, understanding that it's like finding a partner for anything in life, right? You're going to have to go through different options until you get to the ideal partner. This is a partnership. It's not a, no, it's a partnership. The investor is coming to you because they want something, which is returns on their investments, and you are going to them because you need money to scale, to grow your business. So yeah, if there's conflict from the beginning, right, then that tells you to take a step back, to think about if this is who you want to go into a partnership with, because it is a long-term partnership, right? So you need to understand that there's no need for us to start our relationship on such a, contentious ground. So that's what I would say. Don't take things personally, move on. We've also seen situations, and we see that all the time. We've also seen situations where even if an investor doesn't invest at a particular stage in time, it's probably because of maybe priorities don't align at that point, or they only invest at a particular stage. So there's really no need to burn the bridges because we've seen investors pass on things before and then come back to it, right? So that's the most important thing you have to take in mind. You have to keep in mind. Don't take things too personally. Just move on. Panache, please, my first slide. I think the about me slide. Okay, I know what is on that slide. That slide is basically talking about myself. Panache did a good introduction. My name is Mo, and I'm managing partner at Vazi and also founder of Legal Trunk. I started my career in Lagos, Nigeria. Was that? No, actually, I started my career, funny enough, in public service in Osun State, Nigeria. And then that was post NYSC. And then after, that was during NYSC. And after that, I came back to Lagos, which is where I grew up, was born, raised, and started my career in a law firm at the time, in a corporate law firm that was focused on mostly tax advisory. But we're doing quite a bit of, we're doing general corporate law. Now I'm trying to take out the legal jargon. So it was a corporate law firm, but I know I wanted to do, at the time, tech was becoming interesting, not even interesting. It was just a thing that was fresh. And when I say tech, we've always had, this is what I like to call second or even third generation of the tech ecosystem in Nigeria. We've always had legacy tech companies for sure, but at the time when I was finishing law school, that was the time that building tech companies became a little bit more accessible. So anybody or most people could just think about it and be like, oh, what do I want to build? I have this thing where I have a lot of interesting friends. So a lot of friends were trying to just playing around with things, trying to tinker things here and there. And I just found it fascinating that you could build something and it just works, right? So creating things from scratch. So that's how I got into tech, basically just helping my friends trying to navigate different things. And then I decided that, okay, I want to learn a lot more about this. And then I went back to school, did a couple of stuff, mostly around, I have a human rights background, just generally, business and human rights, pretty much not enough. And then I started focusing on venture capital. And at some point, after working in the US for a bit, for a couple of years, I knew that I wanted to come back and I wanted to do work on the continent. And I wanted to focus on tech law specifically. It wasn't really a thing at the time, but I was willing to take my chances, right? So I said, okay, you know what? I want to do this. This is exciting to me. I find it very fascinating. Ever since I'd started at, been studying as a lawyer, it was the one part that I thought resonated with me. I like the fact that I could work with people who are building things that I use on a day-to-day. So it was just amazing. Anyway, so that's my professional background, and that's how I found myself here. And we've been doing this, for a bit. Now, the next one is my personal background. My personal background, again, something very similar. I grew up, born and raised in Nigeria, in Lagos. Since then, I've lived in several places, several different cities and several different countries, but Lagos is home and it will always be. I'm currently in Lagos right now. I have a very interesting relationship with Lagos. I also am I'm very particular about, I'm very particular about building a life outside of work. So my personal life is very full, very rich with different interests and things that I enjoy, which is one of the things that is on this slide. And I thought to talk about it because it's a huge part of me. I'm very big on gardening. I have an ornamental garden and also an edible garden. I grew up around plants, and I remember that one of my first jobs in my house, as soon as I was maybe like 5 or 6, was to water the plants, in the compound where I grew up. Grew up with plants. I love animals as well. I grew up with dogs. I don't have a dog right now, but I do have a puppy nephew. So he's very important to me as well. I have 9 siblings, so it's a very big family. I'm very big on family as well. And I'm very curious about how other people do things, why they do things the way they do. And so I gravitate a lot towards exploring. I travel for learning, education. So that's also a big part of me. What do I spend time thinking about? So I'm going to tell you what I spend a lot of my time thinking about, and you can just type in the comments what you spend a lot of time thinking about. It could be anything. I think it's a good way, to know the people in the room and things like that. So I spend a lot of time thinking about very, very deep questions like, what's the end game? Why are we here? What are the things that we're supposed to do? Am I here doing what I'm supposed to be doing at this particular moment in time? What does it all mean? And I know that it sounds very, very vague and very, but the reason I think about that a lot is because it kind of dovetails into my general attitude to life at the end of the day. So if something is not consequential, I just wouldn't pay it any mind. So I'm going to give the next I guess, 30 seconds. If you could just do me a favor and just type, what do you spend? Oh, I also spend a lot of time thinking about food as well. Yeah, it's always, what am I going to eat now? What did I eat in the morning? You know, stuff like that. That one is part of it. So if you could just type in the comments what you spend a lot of time thinking about, it could be anything random, that would be great. Panashe, in the meanwhile, while we're typing, can you please move to the next slide? How to make money fair, fair. Sleep and food, I love it. Two very important things. We have about, what, 21 people in the room. So money, food, adventure. I love it. Money making, learning more about the intersection of law and AI governance, and also travel. I spend a lot of time thinking about my life, how I actually, okay, how to spend the money I make. I love it. Interestingly, so we have a lot of people thinking about money here. That's great. So our next slide is, let's talk money. Now, so the way I put my slides, I'm going to talk through them. And the first question that people have is, when is the right time to start thinking about? The right time to think about fundraising is every time. Investors would, founders would tell you, founders who have raised money will tell you that they are constantly always raising money. Now, it doesn't just mean that everybody is supposed to raise capital. It's possible to build a bootstrapping business. And by bootstrapping, whenever I use any term that appears to be technical, I will just explain it. And by bootstrapping is basically meaning that you are growing the business with your personal money and money that the business makes. Sometimes you might get, support from family, or maybe friends, or, like a long-term loan, something like that, but the person doesn't become a part of the business. Basically, you're bootstrapping the business. You don't have any institutional investors in the business. That's what bootstrapping is. So it's possible to bootstrap a business entirely from scratch. And the reason for that, and some entrepreneurs actually do that, and they do pretty well, to be honest. And that simply means that you are going to grow just as fast as the money that you can, the resources that you can access at a particular given moment, right? Because you are going to be leaning on your personal network, personal experience in order for you to be able to raise capital. So essentially, your growth is really tied to how much financial resources you have available to you or to your disposal at every given point in time. Raising capital and bringing investors into the mix means that your obligations begin to change. And that's why I started this conversation by saying that when you have an investor, it's a partnership. A lot of people go into that relationship thinking that, okay, it's just their money, this is my business. To be honest, the moment you have an investor, it is no longer your business. It doesn't mean that you've lost ownership of the business. It just means that it is now our business. So you and your investor are running the business. What that also means with anything that is communal is accountability. Accountability means that there are certain things that you now need to either get permission or report to a particular, and we'll talk about this, in detail as we go along. You report to a particular institution, could be like a board. It could be informal as, your investor or an advisory board. It could just be your first, second investor. They're giving you capital for a particular thing. So you kind of have to actually you have to make sure that that money is used in that way. So it becomes, a bit tricky, because at that point, once investors come into the mix, it has colored, the flavor of the business. It means that the business is not only your vision, is now a communal vision. Also understand that it's not all investors who, actually most investors do not invest their personal money. They are investing behalf of other people. So they have limited partners, which the usual term for it is LPs. So they also even have obligations to their LPs as well. If their LPs care about certain things like gender equality within your business, which you should then definitely care about anyway, it will trickle down to they asking you for figures to show that there's a gender balance in your team, or the steps that you're taking to address any gender imbalance, right? So again, the value system of the business, the priorities of the business begins to change. The speed at which you can take decisions begins to change as investors come in. But it doesn't mean that it's all bad. It is not, or it doesn't mean that it's bad. It's not. In fact, being able to use other people's money to grow a business is probably one of the best invention of capitalism, because it now means that you can leverage other people's resources with an idea that with the proper resources, right? You can make 10x, 20x, 30x the investment. So it kind of gives people a bit more access to build things out that would make, an outsized return. So the right time to start thinking about fundraising is once you've figured out the type of business you want to run. Are you okay with having your business as a small mom and pop shop? And there's nothing wrong with that. There's nothing wrong with saying, okay, I'm just going to grow day to day. And then that's fine. There's nothing wrong with saying that I'm just going to take money that my business makes to grow. I don't want to be a big organization. I don't want to be a 300 employees or even a 30 employees. I want to stay with my 5 employees. It's okay with that. That's fine as well. So once you figure that out and you're like, okay, I'm okay with getting partnerships on board, then it's a good time to think about it. But more often than not, in my experience, dealing with founders who are trying to raise money, they get stuck on, the mindset hasn't shifted. It hasn't shifted from, oh, this is my thing, to this is our thing. So they always struggle to make that adjustment. But again, they have somebody else's money. So you need to be able to put yourself in the mindset that now is a partnership. Now, the next thing I have on my slides here is, where should I look to? This is, one of the questions that somebody had mentioned in the comments earlier. Where you should look to is where other people are looking to. And what do I mean by that? So you are going to have to sit down and look at people in your industry and see who has invested in who. I spoke about the fact that investors themselves do not hardly invest just their own money. They are investing on behalf of other people as well. Every investment firm in itself has priority areas. They have an investment thesis. They have the sort of, call it a so they have a checklist, if you will, of the kind of businesses that they want to invest in. So you find that investors invest in similar verticals. Maybe it will differ across jurisdictions. So when I say look for similar businesses, I also mean outside of your jurisdiction, right? So let's say you run a personal care brand. So you make cosmetics, things like that. And you now want to digitize it. You want to have to build out an e-commerce platform. You don't have the funding to do that. Or maybe you've created something like a minimum viable product and you now want to scale. One of the things you can also do is look at similar businesses in other jurisdictions, right? And see the type of investors that have invested in those businesses. What that does for you is that it helps you to clear out the noise. And then you now begin to see the sort of investors that you should be reaching out to. That gives you a template. It's almost the same way that you have like a customer avatar, right? So you can now have an investor avatar. Okay, an investor who's interested in personal care. Since your business is in Africa, I'm just using that as an example. Okay, an investor who also invests on the continent or invest in a particular country. So it gives you, you know, a targeted approach to see the kind of investors that you want to approach. Once you do that first background, it becomes clearer to you where you should be having conversations. A lot of investors, to be honest, allow cold emailing and cold outreach. They will tell you that you can, fill stuff on their website and things like that. But another thing that I also know is that walking through people in your network to try and get introductions also probably would give you the best results. So again, where you want to look to is following the money, right? Following the money to see who's spending on what and where. And then it gives you a template of the type of investors that you should even be reaching out to in the first place. What happens with that is once you start having one conversation with an investor, it sets up a chain reaction. Even if that particular investor is not interested in your business, or maybe they can invest at that particular point in time, or maybe the priorities don't just align, you can now ask them and say, hey, can you introduce me to other similar investors? There are also many places that investors converge, from conferences to workshops to things like that. You want to pay attention to your industry and pay attention to the conversations that are being had. And because you can't really build a business in isolation, right? And then once you are paying attention to the conversations that are being had in the industry, then it becomes clearer to you as well where the investors in your industry converge. One of the things that you want to consider is something that I talked about earlier, and it is if you are ready to go into a partnership with someone. If you're not ready to do that, then it's probably not wise for you to consider fundraising at that particular point in time. So I have a question here, and I'm not going to answer this question because I kind of answered it earlier. So I wonder who has the answers to it. In an investor-investee relationship, investor-founder relationship, who is doing the other a favor? You can just type your answer in the comments. To clarify, my question is, in a founder-investor relationship, they're about to enter into a relationship, who's doing the other person a favor? Is it the investor who's doing the founder a favor, or is it the founder that is doing... Yeah, so I talked about it earlier. It is a partnership that is mutually beneficial. And that's the mindset shift that you need to be at the time when you are starting to fundraise. If it doesn't work out, it doesn't work out. You walk away and you move to the next one. Can I have the next slide up, please? Oh, this doesn't come up, but it's fine. I know exactly what, yeah.
Okay.
This email I think there's someone who needs to be muted. Okay. So in this particular slide, we're talking about the stages of funding for startups. What should have been here on the orange state is, pre-seed. So there are different stages. So you have the pre-seed, you have the seed stage, you have the early stage, you have the growth, and then you have exit. I'm just going to run through this very quickly. The pre-seed stage basically is, think about it as the growth cycle of a plant, right? So the pre-seed means that this is before seed money actually comes, before you actually have the first set of money that comes into your business. At the pre-seed stage, people would typically use their personal money. They would try and, or even sometimes they're not even spending that much, right? So they would try and get their personal savings. If the business, trying to get to a point where the idea, where they can test whether the idea is valuable in itself. A lot of these stages most times bleed into each other. What I mean by that is that there's no clear cut that just because a company can be both pre-seed and early stage at the same time. A company can be both seed stage and early stage at the same time, right? A company can be in its growth stage and then it's looking to exit. And exit basically just means at the point where they announce that this company has been acquired by XYZ company, that's an exit. So going through this, so we have the pre-seed stage where it's just fresh. We're trying to figure out, is this idea even valuable? We have the seed stage where you put in more of your personal savings, credit cards, if it's available. I also want to say that this particular slide was created with the US context. So you would see certain things around, dollar values and approximate funding. That's not really typical. These figures are not realistic or reflective of what happens in our own ecosystem on the continent generally. So you have the seed stage, then you have the early stage. Seed stage, I personally define as the first set of money that comes into your startup. The thing with seed stage is that at the seed stage, you could have different types of investors. You could have people who are your friends. We typically call them friends and family. You could also have some investors who, even if they are institutionalized as venture capitalists, they invest in very early stages, right? Because that's their investment thesis. They just invest in very early. They want to be able to come in early, take a lot of risk at that stage because they will get outsized return. Now, so you could also, again, in these different stages, you could also have some of the investors listed underneath in different stages. What I mean by that is you could have angel capital in a seed stage company, right? That's fine. Early stage is pretty much, post-seed. It's still early stage, even pre-seed, right? But at this point, the company is getting some more meat on the bones. There's now there's some traction, if you will. There's some structure within the company. At this point, the company has probably gone through 1 or 2 accelerator programs, is in a lot better shape with its legal data room, with its compliance. It looks like there is hope. At this stage, the company is talking to venture capitalists, having those conversations, probably is in a better place where they have their books in order, or their books are almost there to be in order. And then banks are willing to talk to them about loans and things like that. It's also possible to get grants, at this stage, even at the seed stage as well. You also notice, just like I said, that the sources of capital for the different stages also bleed into each other as well. The growth stage, again, is at this point, usually, the company has found product market fit. The company is on an upward trajectory. The company is growing. And this is the point where you now begin to hear things like, Series B, Series C, and all of that. And those series that you hear is just stages of fundraising. So the first real institutional money that comes in at the time where the company has a priced round, where the company in itself is priced, right? What is an actual valuation is the Series A round. And any other round of investment that comes in after that basically just follows that. So post Series A will be Series B, Series C, Series D. So if you've seen that, that's essentially what that means. So on the growth side, so you have all of this same thing, venture capital, people, there's specific VCs that invest in mature companies. So they come in at this particular point. The check sizes are usually much more bigger. And then that's what happens at the growth stage. At the exit stage, you are thinking about like later stage investors, usually the same type of investors that invest at the growth stage. You could see things like hedge funds come into play at this particular point in time. Usually, people see a lot of equity and private equity firms coming at this particular point in time, because the investment style or investment thesis for private equity investors is very different from venture capitalists, right? Private equity investors most times or almost all the time buy companies that are already mature, and they just need a massive injection of capital for them to be able to move to the next stage. So you typically see private equity firms play a lot more here. Banks, you can have a management buyout, you can have an IPO. That's what happens at the exit stage. So next slide, please. At this point, I'm going to ask two questions. The first one is, does anybody have any questions so far? If you do, please put it in the comments. And then Panache, my question is to you. I would like to know how many minutes I have left, just so I can manage my time a bit better.
I'm around 7 to 10 minutes.
Okay. All right. And there's some flexibility, right?
Yes, there is. Yes, there is.
Okay. All right, cool. Thank you. So first things first, the landscape is changing. I wouldn't say, we talked about this earlier, I wouldn't say that things are harder, maybe slightly, but the priorities are changing. And it's just normal, because during this, our second phase or third phase of our tech ecosystem generally, a lot of investors or allocators of capital were trying to understand the ecosystem, and the ecosystem was also trying to understand the investors as well. And I feel like we reached an inflection point where there is now a lot more structure around the nuances of our own ecosystem. Because initially, investors were investing and startups were also receiving money just based off, say, like a Silicon Valley template. We still kind of differ to a lot of things structurally as it is done in Silicon Valley, but now it's a lot more nuanced with local context. So there are many things that you would see in investment agreements generally that sometimes is not typical, but it is just a reflection of the nuances in our own ecosystem. The second thing I also want to talk about, and I talked about this before, is understand your positioning. And your positioning is what I want us to go away with on this call, that it's the mutually beneficial relationship. Any investor that is making you feel like they're doing you a favor, you need to walk away, right? If you can, because I know it's not all the time that you can, but, or the first things that you want to do is that you want to change that dynamic, right? And let them understand that you understand your positioning. Have plans B to Z. This was basically tied into what I said before about the fact that you need to be in a position where you can walk away from a conversation. There are different places, there are different times and places where you would get to the last conversation and it's just like, okay, send wire details, and then the investor pulls out. We've seen that happen rarely, but it does happen, right? You could have a situation whereby you've gone through extensive due diligence and then the investor says, oh, you know what? I'll rather move on. Or you can even have situations where in the process of due diligence, you get to find out about the investor some more and you're like, okay, you know what? I'm not interested, and you walk away. So never think that one person that you're speaking to until you have the money in the bank, that should not be your only option. So I didn't say have a plan B. I said have a plan B, C, D, E, F, up to Z, right? And then we talked about this yesterday. Another thing you need to do when you're considering fundraising is get your house in order. You need to have a proper legal data room. If you were not on the session that we had yesterday on compliance and legal, you should probably go back to that. I believe that that particular section was recorded. You need to get your house in order. Getting your house in order puts you in a stronger position, makes the potential investor understand that you are serious-minded and that you understand what it means to build a business that has structure. Next slide, please. So vehicles. So when you are thinking of investing, raising money from investors, there are many types of vehicles that you would come across. The most popular one, especially since we're talking about scaling from zero, and we're having this conversation from scratch, is the SAFE. So the SAFE is basically simple agreement for future equity. If the agreement is simple, I don't know if it's a simple, if anybody has seen a SAFE. Is anybody here that has seen a SAFE before? Would you classify it as a simple document? You can just put it in the chat and let me know. So the SAFE in itself was a document, and I want to talk about the history of the SAFE just a little bit. The SAFE was a instrument that was created by Y Combinator. Y Combinator essentially is possibly one of the biggest accelerator programs right now in the world, I think, in terms of size of the accelerator program itself. And they're very big on creating documentation that has helped the tech industry in Silicon Valley grow. So not knowledge sharing and things like that. And they come up with the SAFEs because they wanted to figure out a way that founders could easily raise money from investors in a simple way without having to deal with extensive legal documentation. Because at this time, the founder cannot afford, expensive lawyers, and then there's a race against time. So that's the history behind the SAFE. And I like to tell that history because as time went on, that's core reason why the SAFE was created in the first place began to get eroded. So what a SAFE essentially says is, I'll go back to the definition again, simple agreement for future equity. Give me money now, you get the equity later on. Later on is usually at the point where the company in itself has now been valued. There's a price to know exactly how much you need to pay. And then that is locked in. Convertible notes is also another vehicle that is really used to raise money at an early stage. And what convertible notes are, just in the name, that's why I love it, right? It's very simple. This is a note that converts. So essentially, it is seen as a debt. So you take money from an investor for a certain period, which is the maturity date, at a certain interest rate, and it is there. Now, at the maturity date, most convertible notes are typically 1 to 2 years. At the maturity date, that interest plus the capital plus the initial sum would now be converted into equity in the business, depending on how the agreement was with the investor. You could have agreed that, okay, it would be, you could have agreed that, oh, you know what, the conversion has to be at the instance of both parties, or at the instance of the investor, or at the instance of the company, which is rare, but it's an agreement as to how that debt turns into equity later on. Or if at all, at the particular point in time, at the maturity date, if the company has the money plus, that's the liquidity, right, to pay the investor plus the interest, they can have a conversation where it's like, hey, we don't, we want to pay back and we don't think that they should convert. Again, that really depends on what the convertible note is. The convertible note sometimes automatically converts. Some is at the instance of either party, but that's what a convertible note is. So like I said, I tried to take away all of the jargon. Safe, pay now, get later. Remember that. Convertible notes, debts now, equity later. For price equity round, pay now, get now. Very simple. So a price equity round basically is from the name, saying that you are paying a particular price that has been allocated already. The company has been valued. You are going to buy this particular share in the company at a particular price, right? So these are the common vehicles that you would see typically when you're trying to raise capital early stage. Next slide, please. So the stages of capital raises. Now we're moving from the, discussion around fundraising to kind of like the technical bits of it. Again, I tried to make this as simple as I could, so we're all on the same page. So the stages that you have is the information, discussion, introduction. Either you're reaching out to the investor or they're reaching out to you. Somebody makes an introduction, you would have that. They would send you something that is called a term sheet. A term sheet is basically a document that outlines the terms upon which they want to invest in your company. I'll talk about term sheets in a bit when I talk about some problems. After the term sheet has been given to you as a founder, you're supposed to look at it, go through it, figure out if you are okay with the terms or not. Usually best to get a lawyer at this particular point in time. And then you sign the term sheets. They would sign it as well. Once the term sheet has been signed, you go through a due diligence process. Due diligence is basically the investor looking under the hood to see what is going on in the company. There are different types of due diligence depending on the kind of business that you run. There's the legal due diligence, which we kind of talked about extensively yesterday, but it's also due diligence on the product itself. So they would due diligence product people. So by product, there's going to be due diligence on the tech. If it's what is the technology, what is the IP, right? Due diligence on that in itself, not on the legal side for IP, you're talking about who owns what. Due diligence for the tech is basically, your tech stack, right? What's happening there. Due diligence with your people. Some investors really, really care about how employees are treated in the company. They would do that as well. Where I sit, usually because I'm a lawyer, I sit on the legal side, but I also wanted to make sure that you understand that there are different types of due diligence that will happen. There's also the financial due diligence, which is going through your financial documents and saying how money is spent. Then after due diligence is done, the next thing is to close the investments. By closing, we mean material agreements are now going to be signed. The term sheet is signed, but the term sheet is not a legally binding document. It is basically an intention. And a lot of people miss that. They think because I've signed the term sheet, oh my God, I'm locked in. It doesn't mean that. So at this point, after due diligence, that's when you now have the material agreements. The material agreements are now sent to both parties. they go through it. If they have comments, they kind of like, go back and forth on that. Then there's disbursements. Disbursements would typically be in tranches. And what this means is if the investor is investing $50,000, for instance, they can say, okay, we're going to give you $10,000 in every quarter, or we're going to give you $10,000 until a particular thing is done or a particular stage is achieved. Perfection is we have gone through all of this stage, disbursement has now been finished, and then this is the end. So these are typically the stages that you would see in an investment transaction or discussion. Next slide, please. So what to get familiar with? I don't have a lot of time, so I can't go through each of them specifically, but I will try. So when you are trying to have conversations with investors, there are certain things that you need to know as a founder. Valuation, right? Pre-money valuation essentially is what the company is valued at before the investment comes in. So so that's what the pre-money valuation is. Post-money valuation is what the company is valued at after the investment has come in. These two are very, very important because you can lose a ton of your company and a ton of money without understanding the difference between pre-money and post-money valuation. So you just need to understand what they are. If the investor is coming in at the pre-money valuation, that's if they give you a valuation, or they're coming in at a post-money valuation. Valuation cap, basically just as it says here, is the maximum value at which investors' money will convert to equity. We talked about the fact that in something like a SAFE and a convertible note, you're paying now and they're getting equity later. If somebody is going to get equity later, we need to talk about the price at which they are going to get that equity, right? But remember that the reason why we have a SAFE or we have a convertible note is because we haven't valued the company yet. So we don't even know the value of the company. So in that instance, they would have something that is called a valuation cap. And what a valuation cap essentially means is that this is the maximum valuation, no matter how much the company is valued at. If the company is valued at 50 million, if the company is valued at 50 million in the future, when you do a price round, right now, right here, we're agreeing that the maximum valuation at which my money as an investor would convert in the business to equity is going to be capped at this. Why that is important is because the higher the valuation of the company, the less the investor can buy, right? So the less shares that they have. So if the investor gives you $50,000 and the company is valued at $250,000, it means that they are going to get 1/5 of the company. If the investor gives you $50,000 and the company is valued at, say, $1 million, they are going to get significantly more. Significantly less. So that's why valuation caps are important, because investors want to be able to cap, to be able to control how much of the company they can get. You have something that is called a discount. You also have a discount rate. I put the two here because sometimes people mistake them. A discount basically is just saying that, let's say the company you've agreed on a valuation or a valuation cap. You can now choose to give a discount, right? Usually not both. Usually the discounts would appear where there's no valuation, where there's no valuation cap, where it kind of says something like, okay, if the business is valued at XYZ amount in the future, this particular investor's investment in the business is going to be converted at this rate, but at this discount, right? So the discount will be 20%. Now, discount rates, you see that in some documents, and it's very different from the discount. The discount rate in itself is 100%, minus the discount. So if you're giving a 20% discount, your discount rate is going to be 80%. Some people kind of mistake that. I've seen that before, where the figures were flipped, and instead of giving a 20% discount, the founder ended up giving an 80% discount. So again, know the difference between discount and discount rate. Preferred shares basically are just shares that investors would typically ask for. They're called preferred shares because they have extra rights that are attached to the shares. Whatever the investor is asking you specially would now form a class of shares that is called preferred shares. Common shares, common stock, depending on the jurisdiction you are in, is basically the general stock that a company owns. That's the one that you as a founder will typically have. Your capitalization table, we talked about this earlier. The capitalization table is basically a document that shows who owns what in the business. I'm breaking it down simply just so that you're not bamboozled with a lot of these terms. They're very simple. Dilution basically means the amount, because just as new investors come into the business, we need to give them shares. In order for us to give them shares, everybody else has to be diluted. So think about it as a jug. And we all have poured, from the jug into our cups. If somebody else comes into the room, the jug is empty, we now have to take little bits from our cup and give to that person as a new investor, right? It means that whatever you have in your cup is going to be reduced. But at the same time, you're not essentially losing value, because as new investors come into the business, ideally, in an ideal situation, as new investors come into the business, the value of each share in the business is going high. So even if you have less shares, it doesn't mean that just because you have less shares, the value of those shares are less, right? So dilution basically just talks about the pop water scenario. That's my best analogy. And at what rates, your shares would be reduced as new investors come in. Most favored nation clause typically is not called a most favored nation clause in the agreement. It could be called different things, but essentially what an MFM clause means is that there's going to be a clause in the investment agreement that says something like, if you give another investor terms that are more favorable than this, then I, as an investor, even if I've signed this particular agreement, I'm going to be entitled to the terms that you've given to the other investor. Now, there are certain times where you probably want a strategic investor on board or things like that. So you tend to give them more favorable terms. So if you have an MFN signed, that kind of puts you in a tricky position. And this one thing that we see happen quite a lot. So I want to say that if you have an agreement that has an MFN clause, you want to think about it a lot more critically. Panache, please, next slide. Okay, I will try to. I have 2 minutes left. So these are things, I'm going to rush through them. Things you should care about: ownership, control. So no matter what the terms that an investor is giving you, you need to just look at it. And then, because some of those things are going to be, they're going to be, in complex terms and things like that. But one of the things I always tell founders that I advise is that focus on the end goal. No matter how complicated the clause is, what exactly is the clause trying to do? As a founder, again, I talked about the fact that you're bringing other people into the business, so it's a partnership. But at the same time, you want to make sure that you're not giving up too much ownership or too much control. Next slide. I think the next slide should be my last slide. No, it's not. Okay, so things investors might care about, they also care about ownership control. They also care specifically about things like liquidation preferences, anti-dilution, drag-along rights, pro rata rights, information rights, right of fresh refusal. I wish I had some time to go through this. If we have some time later on, I would. But yeah, next slide, please. Panache, please, the next slide. I don't have my next slide on yet. But specifically, one, I can quickly explain. Information rights is very direct. Basically, they want access to certain information and they will tell you exactly what it is. Right of first refusal basically means that before shares are offered to anybody externally, it has to be offered to them first. Pro rata rights essentially mean that if an investor wants to maintain their size of investment in the business. So those are pro rata rights. I'm going to end with this, right? And I think it's the most important point of all. The investor-investee relationship is not adversarial. It's not a fight, right? It should always be cordial. Of course, some certain tough decisions would have to be made, tough conversations would have to be had, but it's not adversarial. And that's one of the things, the main things that I want you to take away from this. So I have been told that I am out of time, but I hope that this session gave you some direction about thinking about fundraising as the first time, or maybe a second time or a third time. And Legal Trunk, thank you very much for having me. Thank you.